So basically, session number 1 is geared towards us understanding what is expected of us. All right. What are we supposed to, in this case, to appreciate as regards advanced financial management is concerned here? So I'm looking for advanced financial management in the syllabus. So I can see already it's here. It's on page number 54. Page number 54 of this syllabus, All right. Then my role is basically to take you through the entire syllabus of the AFM for us to appreciate what really is expected of us for us to be able to pass this paper round 1. Remember, the concept here is that we should be able to pass this paper on the very first attempt. You should not go to the second attempt. So it's paper number 15, Advanced Financial Management. This paper is intended to equip the candidate with knowledge, skills, and attitude that will enable him or her to apply advanced financial management techniques and methods in a practical work environment in both private and public sectors. Learning outcomes. A candidate who passes this paper should be able to, number 1, make advanced capital budgeting decisions and make appropriate capital structure decisions for an organization. So you talk about capital budgeting decisions. I mean, we know that capital is very scarce, and there shall always be many projects here competing for this capital. So we will have, for example, project A, B, and C competing for 10 million, which in this case here will not be enough. So then we have to budget for the 10 million optimally. We must look at, for example, these 3 projects, A, B, and C. Which one has the highest net present value? And that is what we shall be able to work with. When we talk of capital structure, we are looking at how do we finance our organization. So mostly we finance organization using owner's equity, what the owners have been able to contribute, and then of course what shall be able to get out there as loans. So we have here debt, we have equity, and at times when we get, although this is quite remote in Africa here, we have a preference share capital. All right. Then in this case here, what should be the order of us borrowing? What will be the optimal proportions of these capital structure components? Then we shall be able to evaluate portfolios and apply CAPM. CAPM is capital asset pricing model and other multi-factor models in financial decision making. So remember, it will be very wrong of us to always put our eggs in one basket. You should never put all your eggs in one basket. You shall diversify. Have in this case here your basket split into, say, even 2 or 3 baskets, so that you in this case stumble on a rock as you're walking to the market and maybe you fall down, then automatically we will have one basket having all its eggs, in this case, you're broken. If you had put all your eggs in that very one basket, then you lose everything. But if you had, in this case here, diversified your risk and put your eggs in 2 or 3 baskets, then automatically some basket here will be safe. So even in our investments, don't be like a friend of mine who got 15 million Kenya shillings from Kenya Airways when Kenya Airways was really Kenya Airways. And then he went with this 15 million and all of it, he was able to put it in some building, which later on was demolished. All right. So if he knew this 15 million, maybe 5 million would have gone to a building. Buildings are not bad, real properties. They're not bad, but don't put everything of yours in them. Some other amount, buy shares. Some other amount, buy, in this case here, government bonds. Some little amount, put in what we call money market fund, your emergency fund, all right, which you can withdraw, in this case, in times of emergencies. All right. So we're going to study portfolio quite a lot, and we're going to see how we can use CAPM to get our cost of capital. CAPM is very, very popular. Then number 3, we should be able to apply the relevant models and skills in prediction of corporate failure. over 60% of businesses established in East Africa collapse before they celebrate their second birthday. They collapse, in this case here, before their third year. All right. So then as a finance manager, I should be able to predict what we call financial distress. I should be able to measure. And then, of course, my role will be to ensure sustainability. I'll be able to advise these people, like, what do you need to do for this company of yours to be sustainable? Number one, for example, work well within your budget. Especially your directors. Directors are the ones, in most cases, who eat up their companies. You get a small company that just started 3-4 years ago. These guys are paying themselves like 300,000. Even that is much better. You'll get others who don't know the business entity principle. When they do a contract and they get 2 million, 3 million, they want to eat everything. They don't know that that money belongs to the business. All right. So under financial distress, you're going to look at very good models of predicting this financial distress. We have here apply derivatives in financial risk management and apply international finance concepts. So derivatives, as we shall be seeing later on, these are basically financial instruments that are used to manage risk. All of us would want to have them because, I mean, ladies and gentlemen, the environment outside is cloud with what here, lots of risks. So remember, like Kenya Airways some time back, they had an issue. This is when fuel prices were increasing every other day. Every other day, fuel prices were increasing. And then they went and bought what we call a fuel collar derivative. Collar means that, I mean, we have like a maximum price beyond which our fuel prices cannot rise. So assuming that the collar here was 190. So what does that mean? That if the price is lower, then automatically Kenya Airways is able to do what it will enjoy. But if it is more than, of course, in this case here, like 190, then in this case, if it's like say 300 or 250, then that fuel seller, fuel distribution company cannot increase the price for Kenya Airways beyond 190. So in this case here, that is a very good example of a fuel derivative. A very good example of a derivative, I mean, which we use to manage risk. We have other types of derivatives. For example, we have what we call options. We'll be looking at them. We have what we call swaps. We have what we call contracts here, forward contracts. We have futures. So we'll be looking at all that. You're expected, ladies and gentlemen, to appreciate derivatives. This is a common examination area. Then we have the concept of evaluation of mergers and acquisitions. Evaluation of mergers and acquisitions. Ladies and gentlemen, to merge, come together. When you have two or more companies like A, B, C, when they go to the registrar of companies to have them dissolved, and then they come together, all right? So A plus B perhaps equals C. So A plus B disappears, and then we have a new company being created to take over assets and liabilities of company A. Then we call that one a merger. So around a merger, the old companies will always lose their identities to form, in this case here, a pretty new company called C. That's a merger. We are required to understand how mergers operate. For example, we had some time back, if you remember, NIC folding up, CPA folding up for them to form a new company, which is now doing very well, called the NCBA. Companies form mergers for them to be able to fight competition in the industry, to grow their muscle, which will be able to ensure that then they play very well in this industry. Like right now, I mean, NCBA is fighting with the who is who in the banking industry. They're up there together with the KCB. They're up there together with what your Equity Bank, simply because they were able to, I mean, two young institutions, small institutions coming together. By coming together, they've been able to build enough synergies to fight now with the who is who mergers. And then we have what we call acquisitions. If A acquires B, If A acquires B, then it is B that will disappear. B will disappear. So in acquisition, what we call takeovers, A takes over B, then automatically B disappears, then we are left with A. Listen and listen to me very well. If, for example, you were to put a cat, an animal, and a rat, if you put them together like this, will that be a merger or an acquisition? If you were to put them together, a cat and a rat, put them together like this, will that be a merger or an acquisition? Type there, somebody type there. Would that be a merger or an acquisition? Will that be a merger or an acquisition? They come together. Of course, if those two animals come together, one of them must die. The rat will die. So automatically that becomes an acquisition. Because in acquisition, it's only one company, the one that is being acquired, that will be able to do what? That will be able to die. All right? That will be able to die. So under mergers, all the companies merging die. They lose their identities. And then we have creation of a pretty new company. In an acquisition, the company being acquired, known as a targeted company, the one that is being acquired is known as a targeted company. That is the one that dies. And then we have, in this case here, the acquirer, the predator becoming even bigger. All right. All right. Ladies and gentlemen, we have the concept of what here undertaking corporate restructuring and reorganizations. Once we have a company up here that is in financial distress, you as a finance manager, your role will not be to fight it closes down. Your role will not be to go there and you become a receiver manager, and then your work is to receive whatever receivables that is there for distribution to, using that hierarchy, lenders and then shareholders later. No. Our role is not the role of an undertaker. Our role, should we get a company which is financially distressed, is to do reorganization and restructuring to ensure that that company is resuscitated and given life, of course, now to enjoy in the long term, what we call longevity. Then as finance managers, we must study a topic known as reorganization and restructuring. Apply valuation techniques in real estate finance, not even just in real estate finance alone, but ladies and gentlemen, finance managers are great valuers. We shall be able to look at, for example, if it's RCM College, how much cash flows is it able to generate every year? Those cash flows, given our historical patterns, we should be able to extrapolate, project into the future like 10 years. And then we should be able to use those cash flows now projected into the future and discount all of them. Once we discount all of them using what we call the discounted cash flows, then we shall be able to get the value, the present value. So the present value of those cash flows will be the value of the firm, and I will be able to use that value to bargain with any potential bidders. Anybody would want to buy, and tell them, look at the present value of my cash flows here. They are worth 100 billion. They're worth 100 billion. So they are worth 100 billion. Please give me something like 90 billion. It is, of course, if you have to give me that money still, I don't think I'll be able to accept in this case to sell RCM. You have still a bigger dream for the college. All right. Ladies and gentlemen, having gone through the learning outcomes, now this other one, I'll simply go through it very fast. We spoke about capital budgeting. This is where we shall be able to evaluate individual projects using NPV Using, for example, IRR to see in this case here which projects are most suitable so that we can undertake them, and then we will be within our capital here. Remember, capital, as we said, is scarce. So we have so many methods that we have to study. Expected monetary value, how we get in this case here to measure risks here using standard deviation, coefficient of variation. Advanced methods of analysis, sensitivity analysis, scenario analysis, decision tree, simulation analysis, utility analysis, all these are very big, very good. Impact of financing on investment decisions, the concept of adjusted present value. In incorporating capital rationing, in capital investment appraisals, to ration, ladies and gentlemen, is to limit. If, for example, you're limited in terms of capital, then how do you evaluate your projects, for example, using the profitability index? How will you be able, if those limitations are many, to make investment decisions using linear programming? Incorporating inflation in capital investment appraisal, this is very, very common in exams. Evaluation of projects over an equal lives, using the equivalent annuity approach and the replacement chain analysis, constant scale finite period replication criteria. Very easy, you should be able to look at that. Project duration as a measure of what year? As a measure of risk. And the project duration as a measure of risk, we shall be looking at the famous Macaulay. It's called Macaulay, M-A-C-A-U-L-E-Y. From our next session, of course, I'll be using a whiteboard. So you should not be scared that, how will we be able to even write some of these things? No. From our next lesson, today, first lesson, being an introductory lesson, you're supposed to know Mwalimu here. And then number 2, get to know your content. Get to know the deliverables. What are the outcomes which are expected of us? What are we supposed to plan here? So Macaulay will be the biggest project duration, measure of what year, risk. And then we have what we call real options. And the real options, we shall be able to look at option to delay a project, abandonment option, option to withdraw a project, replacement option, and option to redeploy a project, challenges in use of options in investment analysis, common pitfalls, common capital budgeting pitfalls. As we shall be seeing, ladies and gentlemen, an option is a financial instrument which gives the holder the right, but not an obligation, to procure a certain quantity of a commodity at a certain price. Options are great. Assuming you are here in Nairobi and you're running a chain of hotels, many hotels, one of your delicacies will be the French fries, the potatoes, chips. What do you know about the price of chips? It's not easy for you to increase the price of chips in the market. No, not easy. If you're charging like 100 shillings, 150 shillings, you remain there even for 10 years. You remain there even for 10 years. The only thing that I normally see them doing is to reduce the size, the amount of these chips in one packet. So in this case here, price of chips, quite inelastic. How about potatoes in the market? Price of potatoes, a bag of potatoes in terms of price fluctuates a lot. At times it's 5,000, at times it's as low as 2,000. So you may want to go down there to the farmers and negotiate and have options with them. So if you come up with a potato price option, what then that would mean is that you have the right, but you're not obligated. There's nothing like mandatory for you. So you have an option to buy these potatoes from the farmers, say at 2,000. So they plant for you. 6 months down the line, they call you. Now it's time for harvesting. Come and pick your goods. I go down there. So when I'm down there, and then I realize that there are other farmers who are selling their potatoes for 1,000. Remember, I have what we call an option. I don't have a forward contract. I have an option. An option gives me the right, but I'm not obligated. Should I get people who are willing to sell to me at a cheaper price, then I bolt out. Because options means what here? That these are alternatives. Should I find a cheaper alternative, then I'll always go for this cheaper alternative right away. And we shall be able to study these real options and the other options in detail. Very common in your exams. All right. From there, ladies and gentlemen, we have topic number 2, portfolio theory. I've mentioned about portfolio, that we shall always diversify. Never ever should you put all your eggs in one basket. I'm not against my students in this case are taking risks. But of course, well calculated risks, like when you get like this lady who was calling people, telling people that she can give a return of 35%, 30% per month. And people were able to give her up to 5 million. No, they have to be very well calculated risks here. All right. Always take risks, but ensure that your investments are falling into what we call portfolios. Group of what year? Group of assets for you to be able to minimize your risk. Have in this case your investments, some of them going to the real estate. Have some investments in this case you're going to the money market funds. Have some investments in this case you're going to what year? Going to, I mean, there are so many, even offshore outside there. So long as it's a well-calculated risk. All right. Like, there is no way you can tell me that you are a rich person in this world if you don't have government bonds. As we shall be seeing in CPA, CPA starts with risk-free. We should always start with risk-free. As we grow, we need to take advantage of this compound interest. All right. So we have risk-free assets, first of all. Government bonds are very good, and they're very huge here, government bonds. So I'll start with government bonds here. So these government bonds, of course, they give me interest twice a year. This interest, when I get it, I can remove something small for my consumption and then reinvest back. So if you give me like 40 million today, I normally sympathize with most of my age mates. They get money every time they think about Mugonda, Maguta. And in this case here, what year? Rental properties. Everybody's crazy about rental properties. They're not even seeing a risk of these houses that are being built all over here, and I mean, they don't have, in this case here, a great levels of occupancy. Rental properties are good, but if you give me 40 million today, I'll go and negotiate with government to get about 20% return per annum. 40 million, 20%, that is 8 million shillings every year. And remember, upon maturity, my 40 million will come back. So this 8 million that I'm getting every year, now I can use it to get into real estate now slow, because now I'm diversified, But I can never make, because, ladies and gentlemen, I'm now old enough. I know what is good and what is wrong. And I know rental income. That one, you can never cheat me. Rental income, as much as it's very good, rental income is never passive. Rental income is never passive. I've ever met a landlord on the road, a friend of mine, just running like a madman. And then I asked him, I've been stopped. He was not even able to stop. He continued running. And then later on, I came to discover that he was running after a tenant. What kind of passiveness is that? Our friends of mine, in this case here, whose houses are occupied just up to 50%, even getting 50% at times. But unless this property really is in a very, very good area, but even these good areas, where are they? Who knew that Kilimani would turn to be like a slum? Right now, there are properties coming on, right? The property you're putting up today, thinking that it is going to shine for a long time. It may only shine maybe for just 1 year. To me, I would rather put this money in government stocks. Once I bought government stocks, whatever I will be getting out of government stocks, I can have used to get into other areas, including that real estate, albeit at a lower scale. Someone told me that Mwalimu, the government can collapse. That's a risk I would be willing to take. Do you know what it means by a government collapsing? It would mean that all systems have done what you have collapsed. All systems would collapse. All systems would collapse. Because where is our pension money being invested? Our pension money is being taken to government bonds. All banks, wherever they have surpluses, most of their monies are with government. SACCOs, most of their monies are with government. Then why should I fear as an individual investing with this government, I should never fear. Because by the time, in this case, the government then collapses, then everything will just be a bubble, busting, and that will be it. All right. Then that is a risk I will be willing to take. So under portfolio theory, what am I telling you? That we shall always take risks, well-calculated risks, but most importantly is the fact that we shall never put all our eggs in one basket. We shall never put all our eggs in one basket. We need, in this case, to diversify. We need to diversify. We need to diversify. We need to diversify. Just like children. You know, to get somebody in this case, unless it's medical, unless it's on medical grounds. If it's on medical grounds, no problem. So you get, for example, somebody just getting one child, and then they say that that is enough. Anybody here who is a bit old, like 30, 35 years, will tell you, these kids, in this case, it's God who provides for them. You get them. Get them. Get 2, get 3, get 4. Like 4 is a good number. You're diversifying your risks. You should never put all your eggs in one investment vehicle. Don't be cheated. Of course, this is a debatable thing. Somebody will tell you that 2 is optimal because everybody's getting 2. Nowadays, I mean, with what is happening, I mean, you guys who have children, you will be able to bear witness with me. You get a kid, very good, class 5, they're doing very well. By the time they get to class 8, I don't know what happens. By the time they're getting, if you're a mother of a teenager, you understand what I'm talking about. You simply get your kid, in this case, you're one of them. It will not be all of them, one of them, becoming wild. So if that is the kid you are looking up to, not even in terms of like, kid, you're not looking at your kids in this case here to like give you money in future. You're looking at that social protection. When you get older, you want that social attention. People that you'll be able to call family. All right. So to me, I know it's debatable, but for like this, very good. We shall overcome. We shall overcome. Can imagine now, very first lesson, you're getting a teacher who is telling you to get 4 kids. This teacher must be very bad. Don't worry. One day, you will remember me. If it's medical condition, very good. And of course, others are very busy at their workplaces, but at the end of the day, the kids, the more they are, the better. So they should be able to look at all that. Then we have advanced financing decisions. This is all about how do we finance our company. We have debt equity. How do we come up with these optimal capital structures using the WACC? We have the capital structures theories. We shall be looking at Modigliani and the Miller. Modigliani and the Miller. And of course, others. There are many others. Very good. So we have mergers and acquisitions that have been able to explain what they mean. We shall be looking at how to value them. Very, very important. Corporate restructuring and reorganization. Background on restructuring and reorganization, indicators, cost of financial distress, etc. Like how do you raise money through sell-offs, spin-offs, etc. Then we have financial risk management, types of risks, meaning, nature, and importance of derivative instruments. I've already explained this, and I'll be explaining these topics one at a time as now we move on. All right. All right. So we'll be looking at all this. International financial management, we shall be looking at the Bretton Woods, the Bretton Woods institutions. For example, IMF, we have World Bank. Most of these institutions have really messed some of these countries like in Africa. Why? You know, in most cases, if you ask me, it's not that those Wazungus here don't know that in Kenya, here in Africa, that there is a lot of stuff. They know. And then now they're giving us money into the trillions, knowing very well that they're not giving the nation this money, knowing very well that they're giving individuals here to go and, oil their own pockets like that. And then at the end of the day, who is paying? It is a normal mwananchi. All right. So, like, for example, if it's IMF has got various functions, like stabilization of exchange rates for their member countries. We have what we call balance of payments. To get the balance of payments, we normally take exports minus imports. So IMF would want countries to export more than they import. But have they had a solution really for some of these countries like in Africa yet? No, I don't think so. Because the very first thing that they need to do is to tell us, I mean, you guys, you are our member state. As much as we're giving you loans, how do you enhance your productivity to ensure that you're able to produce surpluses and even get to export? Right now, if you look at Kenya, we're in a sorry state. We're importing even toothpicks. We're importing even eggs. When we import things like that, there will be pressure for the dollar. Because most of these imported goods like motor vehicles, you can't import them using the Kenya shilling. You import them using the dollars. And once then everybody wants the dollar, the demand goes up, then what will happen is that the dollar will become expensive. The other day, we had our dollars here going as high as 160 Kenya shillings. So 160 Kenya shillings per what year per dollar? Per dollar. All right. All right. So, I mean, you will get some countries that are so good in what they're doing. They even have banks to support exporters, like Exim Bank. Exim Bank, in this case, the exports and imports bank. But of course, they are out there to simply encourage people from their country to export goods. Like the China government is so big in exportation. If you export, in this case here, for example, anything from their country, all right? For example, your contractors that you're getting out of their country to go and build in countries like Kenya here, they even give you, in this case here, like they are prisoners to come and assist you. I mean, they are out there to assist their own people to bring in the dollar, all right? To bring in foreign currencies, all right? To get the jobs for their people, all right? So then we shall be looking at these Bretton Woods institutions like World Bank, and we shall be discussing, I mean, are they really helping us? They are very good. Of course, in this case, they are doing, for example, what we call advisory. They advise. Where in this case here, we part ways with them is the fact that they are not putting in enough controls on the money they are lending these nations. I mean, if you ask me, these are the same guys, all right? I mean, they simply, like during Uhuru's time, they gave over, I mean, 2-3 trillion without even following them. And for sure, we know that that money never ended. I'm not political, but I'm just trying to, as a scholar, raise something that chances are most of that money never ended doing much of our projects here. So now we are the ones who are doing what you were paying. We're paying back. So we'll be looking at this international financial institutions, very, very important, amongst other theories, Then we have what we call real estate finance, property. Very good. How do we value these properties? We shall be able to look at what we call the real estate investment trusts. Like, for example, the Kwetu hostels. Kwetu hostels, they operate under the REITs system. REITs is real estate investment trusts. Not all of us will be able to get enough money to build a house, to build a rental property. Then what we can do is to go for these properties that are listed at the stock exchange and buy their shares. So we have what we call the REIT system, real estate investment trusts. They're like unit trusts. So you have a whole house now into many units. Now you buy just a unit, not even a unit or an apartment, but a share. You buy a share, it will be 500, it will be like that. So then we shall be able to look at the advantages vis-a-vis disadvantages of those rates. We shall be able to look at mortgages. Like the other day, they brought a question here regarding like what do you need as an individual to be able to acquire a mortgage from a bank? The requirements. If you are in need of a mortgage, and there are very few mortgages in this country, what do you need? So, for example, I would need what we call a CRB status report. That's why I normally tell my students, don't destroy your CRBs. Don't be among those foolish people who will be clapping outside that have stolen from Fuliza. I've stolen from Hustler Fund. Once you're listed, it becomes very, very hard to get your name off the listing of that listing when you're listed negatively. All right. So, of course, you will need proof of income. Proof of income. Do you have a salary? They'll tell you, give us, like, for example, 6 months. So we should be able to look at all that, and I'll be able to do what we call a loan amortization schedule to show you that mortgages are very, very expensive. But if you play your cards very well, then automatically you will be able to win. You'll be able to win. They're not bad because remember the mortgage asset is also increasing in value. The only bad thing with mortgages is the risk. You take like a 30-year mortgage, chances are in between you lose a job. And very many people are not really thinking of loss of their jobs. How will that affect their mortgage payments? All right. And that is why when you are still energetic, if you have like a 20 or a 30-year loan, ensure that you clear that loan within 10 years. Within 10 years. Like myself, I took a loan, immediately I got a job. All right. Unfortunately, I have been getting good jobs because I'll be able to share with you what I normally do. Yeah, like this continuous professional development, like I do financial modeling for these big banks. By age 27, I declared my mortgage. And it is the same house I've been living in since that time to now. All right. All right. So in this case, you can take a 20-year mortgage loan, but ensure that you are able to pay this mortgage as fast as possible. Never you get windfall. Yeah, windfall income. You never anticipated. For example, I've taught a student very well, and this student has passed the exams, and then they give me 10,000 straight away on my phone, my mortgage account. All right. Because for you to be able to succeed, ladies and gentlemen, you must be financially literate. There are very few people in Kenya, in East Africa, actually globally, who are financially literate. We have a big number of people working without budgets. They simply get their salary and then, God just helps them. They just, picky ponky, 10,000 here, 20,000 here. It ends, they don't have budgets here, which is very, very sad. They don't do financial planning. If you're doing budgeting of your money, then you're financially literate. These are the kind of people, as I always tell you this story, and I hope that young man does not hear Mwalimu saying the story. One time, a certain gentleman invited me, still don't mind actually, invited me to, he thought like this Mwalimu, we want to have some, happiness in all of these young people hotels, restaurants actually. The name is Squabers. So we were there, he was with a company of about 6, 7 people, right? And people in this case here were taking one for the road like that. We really stayed there for about 4 or 5 hours. All right. And in Africa, it's quite sad because in Africa, when you are out there, like I was privileged to do my master's outside there, all right, you'll go to a restaurant, everybody's doing their own bills, all right? But in Africa, in this case, this guy who is financially literate, the guy in this case now is feeling like they're out of the world. The bill that was paid there on that day was 40,000, a lot of money. I even remember at one time there is a certain brand that they bought. People brought that brand to them while singing. It's like the entire restaurant came to a standstill. I'm not against, in this case here, people, having celebrations. They are very good. But are they budgeted for? If they are budgeted for, like the way Wazungus would do. If you see a Mzungu coming to Kenya here for a holiday, that guy has saved like for 3, 4 years. Wazungus can't get to a restaurant easily during their work times, like in their countries. And then they do like $1,000. No. If you see a Mzungu spending $1,000 here, that is a plan that he had for over 5 years. So I'm not against any excitement. So it's always good for you to, ladies and gentlemen, celebrate some milestones here. But please, let's engage in what we call financial planning. That 40,000 that young man paid there, if he had just 10,000 shillings, he would have gotten a government bond. And then, of course, would have simply, in this case here, continued, in increasing his portfolio in the government bond. By the time we'll be retiring, we'll be having like a 40 million worth of a portfolio of investment or portfolio of government bonds. There's no way you can tell me that you're going to pay bills of 36,000, 39,000, especially gentlemen, all right, like on a weekly basis. I happen to be among the advisors of some retirees. Like Standard normally organizes a forum for the retirees where they meet like once every 2 years, and I'm among those people who are called to go and advise. Ladies and gentlemen, the kind of stories I at times hear, those retirees talking about being out there as a retired person is not an easy thing. It's not an easy thing. If there is anything that I would want you to start doing as you work on your financial literacy, unfortunately, financial literacy is not being taught in schools, which is very bad. If you ask me, financial literacy should be taught, in this case here, right away from primary schools. If there's anything I would want you to be thinking about is when you retire, from your very first paid job, from your very first salary, and you ask yourself, have I put something aside for my retirement? People are struggling outside here. And that is why, if you look at, for example, if you allow me, if you look at the CBK pension towers, just 1 minute. CBK pension towers. Just a minute. CBK pension towers, very, very important. I've not gotten a very, very good. This is that house which is very, very smart, which was built by some Chinese contractor. So you can see here, most importantly, that it's carving. It's a twin tower. This is carving. I wish I could get. Look at this one here. Yeah. This is much better. So you can see one is carving the other side, and then this other one here is carving this way, like this. It's CBK pension towers for the old people. Fortunately, down here, it's built on a very, very good base. It's built on a very, very good base. I would want you to go and do research behind the inspiration of this building, why the architect was able to take, in this case here, very, very broad base, nice base. And then we have, in this case here, some bending units, and they are bending opposite each other. The inspiration is, as much as today you are very, very stable, whether you like it or not, time is really moving. Time is on our side. Whether you like it or not, one day you will bend. You'll be lucky by the time you hit 70, you're not bending. It doesn't matter whether you're a Gen Z or Gen Alpha, one day you'll bend. And there's no problem in bending. It's quite a blessing to bend. To become old is a blessing. But what kind of life will you be living that time? Later I'm there saying that, you know what, I can't afford what even a Panadol now. Of course, Standard, they are a little bit better because they are pensioned. Although they are those ones who retired a long time ago, before the pension before they took up a very good pension scheme. You still get them complaining a lot. And then they're lucky because at least they have some pension. Now I have people outside here, you know, you go and read why that thing is bending like that and why they are this is a couple. We have, in this case, when you start hitting 60, 75 years, you're bending, and of course, at the end of the day, everybody will be looking their way. And chances are the wife will join the kids in America. And then you have here the boy child, now he's a boy mzee, who in this case is left here home like a pauper. And why do you think are people running away from it? It's because you never took care of your old age when you were still young. Who would want to be associated with a poor person? All right. And that is why, as a man, as much as in this case we love our wives, our women, we must also have something by their side. And that's what we keep on telling these young men. Have something by their side. Not that they don't know, they should know. Go under, for example, to Britam Insurance. put something there for your pension. Put something extra. If your employer is doing 10% for you in form of pension, match that 10% with another. Also, girls, we have to ensure that we are independent as we grow up because things happen. Like I have a friend of mine the other day who died, and the girl here was, told, no, you can't come near this man's properties. And the brothers were so serious, and this lady chose peace. All right. So things change very fast when you ask anybody. I don't know whether there is anybody who has a retired parent here. They will tell you, fine, we have these houses, they're giving us money. But whatever that makes them so happy is the pension that they receive on a monthly basis. It never misses. And that is why I also tell these great people who are on pension schemes that they should never go and take like a whole lump sum. These pension schemes that will give you, like, say, 20 million at once. No, that money, you have never held even 1 million at a go. If you're given 20 million, that is when you get now a man deciding to marry at the age of 60. That money confuses you. So if I'm the one with that 20 million, I will simply buy the monthly premiums. I'll take, like, say, 6 million, put this somewhere else, transfer because of diversification. I don't have to put all that money in a pension scheme. Take 6 million, put in the government bond, and then the other amount, I buy a monthly premium. So every month I'll be getting something like that till I die. And when I die, the difference will be taken, in this case, to my next of what year? Next of kin. Ladies and gentlemen, we must take care of what year? We must take care of our old age. All right. So go back here. This is why I love teaching finance, because finance is factual. Finance is factual. Yeah, so shall be able to look at all these very good things, ladies and gentlemen. Then we have contemporary issues and emerging trends. For example, we have the cryptocurrency. These are quite risky assets to deal with, very risky. I know friends who have lost serious money. So you guys must be knowing of your friends or even yourselves who have lost a lot of money in Ethereum, Bitcoins. Because there are so many fraudsters who operate in this particular space. All right. So nevertheless, because it's still an emerging issue, remember, like Elon Musk, Tesla now has accepted, in this case here, to be paid using these Bitcoins. So many companies, even in Kenya, there are companies that are depicted, even hotels, are depicted in this case that you can go and pay in Bitcoins. But of course, because of the infrastructure, because now most of business lack this blockchain technology, which is really, really a safe technology of dealing with these Bitcoins and whatever, it collapsed and people are conned. Then we have cloud, but it's supposed to be crowdfunding. Crowdfunding is where you make use of internet to raise money from many people. So many people are paying 10 bob, 20 bob, others 30 bob, like what Murara Kibaso is now using. All right, that's a crowd. You're getting money from a big crowd where nobody will feel, in this case, that they're really paying. It's 10 bob I'm sending, right? Others 100, others 1,000, and then they're able to get what here? They are able to get enough capital for business. And we will teach you something about that. Then we have digitization of financial transactions. It's very important for us to automate all our financial transactions. Big data project finance, very important. Islamic finance, very important. Behavioral finance, and we will tell you what this means. Derivative markets in developing countries, very, very important. So that is it regarding what is expected of us. Ladies and gentlemen, for me to be able to deliver this entire course within exactly 3 months, there are things that are a must. Number one, you must be in what we call the learning management system offered by RCM. And I'll be able to demonstrate how this learning management system works. If you go to RCM, if you go to RCM, we just come here. Yeah. So if you go to RCM here, so we have here RCM Online College, RCM Online College.co.ke. So when you are here, and of course you click enter, all right, you'll be able to get to our landing page, and we've made our landing page to take you straight out to the courses. So when you are here, you can see CPA, etc, etc. So for example, I like using these short courses. So I click, this is what I normally use mostly myself. All right. So in these short courses, you can see I have my courses here. So I'll be able to go to my course automatically. It's very user-friendly. Advanced Excel. Let me just check again. Sorry. It is rarely down. We just check again. Yeah, so short courses. Advanced Excel. There could be a problem there. The page requested could not be found. Try to find in your search or use the navigation above to locate the post. No worries. So if, for example, it's CPA, let me just check whether it's the whole website, but it's rarely. I've never gotten it being down. So intermediate level, CPA advanced level. So CPA advanced level, you'll be able to go to advanced financial management, for example. Yeah, I think that there must be a problem with the website. So then when you get, in this case, ladies and gentlemen, when you get inside this LMS, you'll be able to get notes and the videos inside. You'll be able to get notes and the videos inside there. Notes and what here? Videos. And ensure that you rely on the LMS more than you rely on the live classes. Actually, if you ask me, these live classes are at times a waste of time. How I wish students will be able to grow to a level where they're able to use this LMS. Because in the LMS, those videos, I can increase the speed. If it's something that I'm following very well, I can watch them at one. I wish to behave. I don't know why it misbehaved today. You can put this thing at 1.5 times or 1.25. So a 2-hour class, you can cover it very well in 1.5 hours. You've saved 30 minutes. And trust me, 1.5 speed, you will understand everything there. And the good thing with videos is that you can always do what you pause a video, take your own notes, etc. All right. So that we should be using, actually, if you ask me, I wish it can be even this semester. If you ask me, these live classes should be coming to these live classes to answer student queries, to do technical things, etc. But all those simple things, students should be able to follow them through the learning management system. I've always seen that happening. You'll realize that, like, for example, today in Advanced Excel, I have 300 students. How many students attend the live classes? There are only 80. The other 200 and something, they always, in this case here, rely on the LMS, and you'll always see them on the group saying that, you know what, I've finished watching all the videos. In a week, somebody has finished watching all the videos of a particular topic. And then here I am doing my third lesson, struggling with my students like that with live. I'm not saying that lives are bad, they're good. But students in this case have never understood that these live classes are supposed to be for very technical things. Where we say, for example, Mwalimu, we have watched like the first 4 videos. So you come like now tomorrow. Tomorrow we still have Advanced FM. So I'm going to give you like the videos you should watch. Yeah, that's too soon. Tomorrow is too soon. You can't watch 4. So I'll give you, for example, 1 video to watch. So you tell me, Mwalimu, you have now watched that. This is now what you never understood like that. And then I'll use the live class to give you further insights. Not to come and start like defining like what discounted cash flows are. No, Those ones you can use the videos because videos are very good. You'll be surprised. So one of the things that we want to sell to you is that we should be using more of videos. Make the learning management system LMS your friend, and you can never go wrong. And then most importantly, ladies and gentlemen, you must ensure that you have our revision kit, which is a kit comprising of what year, questions, and answers, discussing the latest questions and answers. So I'll be making reference to that kit a lot. Of course, unfortunately, that one you have to buy at 1,000 shillings. And of course, you'll be able to order from wherever you, from us, we'll be able to deliver wherever you are. And you have our numbers. Our number is 0719 525 1000. 0719 525 1000. For those of you who have never met this Mwalimu, my name is Dr. Joshua Aura. I'll be the one taking you through AFM morning class, and I also have AFM evening class. Today having been our very, very fast session, we shall not be able to stretch so much. Whatever we have done is basically introductory, going through the course outline, and I feel that is enough. And I would want to take this opportunity to wish each one of you a good day. See you tomorrow, same time. Thank you so much, and bye.